Look at the data. Laundromats boast a 95% success rate. Compare that to standard tech startups, where half fail completely. That statistic feeds a persistent internet narrative that these everyday, boring businesses are guaranteed machines for effortless passive income. The reality of making millions in this space has nothing to do with picking the objectively best business model. It requires matching your specific constraints of time and available cash to the right operational structure. If you choose an asset class that demands heavy upfront capital, but you only have your own sweat equity to invest, you will run out of money before you ever open your doors. To evaluate these opportunities properly, we need to map them by plotting the initial cash required against the amount of daily physical labor you have to put in. This chart shows the landscape of boring businesses. Across the bottom, we have the upfront capital required to start. Up the side, we measure the operational sweat equity, or the daily physical labor, needed to keep it running. When we plot 6 core models on this graph, from ATMs and HVAC services to heavy equipment rental and waste management, you see an extreme variance. They spread out from cheap, high-labor services all the way to massive, capital-heavy property investments. Pure passive income does not exist here. Building a highly profitable business requires either writing massive checks up front or committing to a grinding schedule of building operational systems from scratch. If you have very limited liquid capital, but an abundance of time and a willingness to do the physical work, you fit the bootstrapper archetype. The entry-level step into microproperty is the ATM business. You can purchase your first machine and launch operations for as little as $2,100, but an ATM only generates revenue if it dispenses cash. You have to physically visit the machine to restock it, maintain the hardware when it breaks, and continually negotiate with local store owners to keep your equipment in prime locations. Moving down the capital scale to pure service businesses, you can start a commercial window washing operation with nothing more than a bucket, some soap, and a squeegee. Turning those cheap supplies into a $10 million enterprise requires massive physical scale, managing crews of laborers suspended high above the street every single day. The reward for this intensity is the margin. Once scaled, a lean service business can clear a 40% net profit at the end of the year. To capture those margins, you have to master the trade from the ground up. That means attending trade school or spending years working under a successful local operator to learn the mechanics of the industry. By doing the jobs yourself initially, you experience the exact pain points at a daily work. You then use that specific knowledge to build the hiring and scheduling systems that allow you to step back and manage the company. While legacy competitors drain their budgets on outdated radio spots and billboards, your advantage comes from using targeted social media to reach specific younger demographics in your local area. As a bootstrapper, your physical labor is the business. You trade your time and sweat to acquire the operational knowledge necessary to eventually build scalable systems. The alternate route belongs to the capital allocator. This is for individuals holding significant liquid cash who want to leverage tax advantages and secure highly scalable business-to-business contracts. Heavy equipment rental is a prime example. When a specialized industrial air compressor breaks down, it can halt an entire manufacturing plant. They will pay a massive premium to rent a replacement the same day. The financial incentive here relies on the tax code. Purchasing expensive industrial machinery allows you to completely write off the cost of the equipment against your income. Here's how that tax shield works. Buy equipment for $100,000 and you deduct that full amount. Rent it out for $60,000 and that revenue is effectively tax-free because the deduction completely offsets it. You see the same pricing power in specialized commercial fleets. When 18-wheelers break down, a heavy-duty tow truck is the only vehicle capable of moving them, allowing the operator to command a premium rate. The risk is directly tied to the hardware. These heavy assets require expensive, continuous maintenance, and if you cannot hire and retain specialized drivers, a 6-figure truck becomes dead weight on your balance sheet. Laundromats operate on a similar capital-intensive logic. The idea that you can simply set up machines and collect cash is an illusion. You are constantly repairing hardware and managing the location's safety. The ultimate heavy asset model is waste management. Scaling this requires buying expensive fleets of specialized trucks and mastering the daily logistical routing required to hit thousands of addresses. It is an $80 billion market, but entering it means navigating strict environmental regulations and battling large entrenched corporate players. Deploying heavy capital secures large contracts and powerful tax deductions, but it immediately anchors you to severe logistical requirements and the constant liability of mechanical failure. Across all of these archetypes, the easiest way to guarantee failure is to purchase the factory, sign the lease, or buy the truck before you have proven that paying customers actually exist in your market. You test demand by using a fake front-end strategy. You build a landing page and run local search ads to see if anyone in your community actually clicks the button to hire you. When those initial orders come in, you fulfill them by drop shipping the product or renting a third-party piece of equipment at a higher daily rate just to get the job done. You will make terrible profit margins on these initial jobs, and it will delay the official opening of your own facility. But that delay protects your bank account. It effectively drops your financial risk to zero because you are only spending money on fulfillment after the customer has already paid you. This aligns with a proven historical strategy. Focus strictly on the hyperlocal. Dominating the specific needs of a single neighborhood is the necessary first step before you can attempt regional or national scale. Expanding your geographic service area before you have perfected your local logistics stretches your resources thin and degrades your service quality. Validating demand locally is not an optional step. It is a mandatory requirement before you sign a commercial lease, purchase a fleet of vehicles, or hire a full-time staff. Building wealth in this sector requires brutal honesty about the assets you actually hold and aligning them with the operational reality of the business model. This decision flow chart shows your path forward. It begins with your primary resource. You either branch to the left with your time and sweat equity, or you branch to the right with liquid capital. If you are cash poor, you take the bootstrapper route. You avoid heavy debt, enroll in a trade school, and use modern digital marketing systems to strip market share away from local incumbents who refuse to adapt. If you are cash rich, you take the capital allocator path. You acquire heavy business-to-business assets to build massive tax shields, but you must immediately invest your remaining cash into strong maintenance and logistical infrastructure. Whichever route you take, the rule remains the same. You have to validate local demand relentlessly, master the operations in one specific neighborhood, and refuse to scale until your internal systems can actually bear the weight.